This is general information and not advice. Please speak to a licensed finance professional about your circumstances. Standford Financial is authorised under Australian Credit Licence Number 541480. Further information is available at stanfordfinancial.au.
Hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complex world of buying and selling in Ipswich and surrounding areas. I'm Steve Athanates. I'm the owner of NG Real Estate here in Ipswich and a few other locations. I'm joined today by Steve Beach from Standford Financial, a great friend of the podcast. How are you, Steve?
I'm very well, thanks.
Now, you know why we're here. We're talking all things interest rates. The RBA has made a decision for June. What did they decide?
So I guess we were right yet again.
No, I was wrong. I said they were going to drop. You were right. I'll be honest. I said I thought they were going to go down, but they didn't go down. They
paused.
They're on pause.
They're on pause again. So
yay! No more interest rate rises.
So that's 7 months in a row. So the last rate movement was back in November last year. So it's been sort of fairly stable. I guess for the last few months, everyone keeps talking about when. I guess the golden question is, when is the next interest rate cut? They didn't really mention a lot about that in today's announcement. In the media conference that they hold straight after the when they say yep, rates are on hold, and an hour later Michelle goes out and actually does a speech about it, and then there's sort of question time and stuff like that. So they discussed a lot about the fact that rates on hold was the major topic of the discussion. Rate cuts, they asked, was there any conversation about that? It was a flat out no. So they're
interesting.
They're very much not anticipating any sort of rate cuts anytime soon. They did ask the question, was there any sort of thoughts or discussion around rate rise? They said there was a small topic that they broached on, but a couple of things that they did want to talk about was the fact that we don't want to put extra pressure in Australia that potentially could lead us into a recession. So raising of interest rates is definitely sort of a seesaw battle there. If they do that, does it push us over the edge? Rate movements generally takes 12 to 18 months to actually really show any sort of cause and effect. 13 rate rises over 18 months, we're definitely seeing the pressure come down.
Right. Okay, so as part of the announcement, there's always talk about, the things that influence their decisions. A lot of time that's inflation itself, unemployment are some of the key indicators. How are we travelling in terms of inflation? How are we travelling in terms of unemployment?
Yep. I guess where the inflationary pressures come on and where, I guess, the conversation of no rate cut came into effect was what we saw in sort of April was what they talked about was the inflation was at 3.4%, and then last month we were at 3.5%, and then now we're back at 3.6% in inflation. So it has gone up 0.1% for the last 2 months. When we were at 3.6 last time was December last year, so we haven't really moved, so it's gone pretty plateau. Outside of that, I guess the target for the end of the year, so December inflation target is actually 3.2%. So, we're not that far off. So when everyone keeps talking about there's going to be a rate rise, to stem inflation, well, we're almost in the pocket. So we're in that narrow band that they keep talking about, whereas, increasing the interest rate to reduce inflation is one key contributor. But as long as it actually targets and focuses on the right areas. So when we saw in 2022 when inflation was at 8.4%, when interest rates started going back up, it definitely sort of had that cause and effect where we've seen discretionary expenditure go down. But a big thing that came out when you talk about unemployment did increase from 3.9% to 4% for the last month as well.
Which they don't generally like. They want unemployment. Or they do
like it going up.
They want it to go up.
But
yeah, you're right.
At the same time, what they want to see is more jobs being released whilst we see slight in unemployment sort of rates. So just so that there is, again, we talk about supply and demand. So, we want a high demand in jobs, but we also want a high supply there as well. Whereas what we've seen is with massive wage growth, that there's been a lot of pay rises. With wage growth, a lot of people have just systematically got a pay increase. I guess that also can contribute to having extra money to be able to spend in the economy. So consistently increasing wages is also just going to put inflationary pressure. And so as we keep paying more and more and more for services, the cost of those goods have to increase at the same rate.
So were you saying November last year inflation was 8.4?
No, 2022.
2022.
Yep.
8.4, and we're now at 3.6. It's amazing that it was that high. I hardly remember it.
Yeah.
Do you?
No, it's funny. Like when we talk
it's
about
a long time ago.
Yeah, 2 years ago. So it's May 2022 is when we started seeing all the rate rises, sort of thing. So
wow.
It's only been sort of 2 years. So
time flies when you're having fun. Right. Okay. So in terms of the overall economy, generally speaking, we're still considered to be in good shape.
Yep, definitely. So I guess like they talked about. Again, we talk about inflationary pressures. That's the topic of the word of the month, I think, at the moment. But again, when we looked at, or when you break down some of the statistics that they're actually looking at, the major, I guess, contributors to why it keeps increasing is, and everyone knows, is rent inflation. So rent inflation is quite high. Again, insurance, everyone's paying so much more for insurance. Then we saw education costs goes up, medical costs go up, electricity went up, so like your utilities. But what we recently saw in the national budget was there is some relief coming with energy supplements and pieces along those lines as well. Beautiful.
All right, so just to recap, June 24, interest rates are on hold or paused. We're obviously seeing some slight variations in terms of inflation and unemployment, some minor variations, but nothing extreme.
Not that came through. I think there's again, I talk at fear mongering about the fact that there's these rate rises are potentially to come. Personally, still not seeing and again, I'm not an economist, but what I'm reading and evaluating is I'm still not seeing any need or to raise rates to try and stem that sort of inflation side of things.
All right. So now we come to that time in the podcast. Next Reserve Board meeting is in August.
August the 6th, yep.
August the 6th. Prediction time. What's going to happen on the 6th of August, 2024?
I still think they'll be on hold.
I think they're on hold too. So there, you heard it first on the couch with Steve. Interest rates in August on hold. Paused again. That's our belief. So you've obviously got to stay tuned to work out if what we're saying is true. We look forward to being right. Okay, so we'll see what happens. Now, mate, while we've got you, I thought it was, obviously you're from Standford Financial.
Yep.
Couple of little incentives here that potentially could benefit people who are looking to get into the market. You came into our office the other day for our sales meeting, and you were talking about some new initiatives that the government has introduced to try and help
first-time buyers.
and not always just first homeowners. But why don't you tell us about what some of the measures the government's introduced?
I guess, first and foremost, the biggest one was for first-time owners, particularly in Queensland, because we're talking about Ipswich. So they've increased the first home buyers stamp duty concession from $500,000 up to $700,000. So that means for a first-home buyer entering into the marketplace, you don't have to pay stamp duty up to $700,000, and there's a concession even further up to $800,000 before you're back to, if you bought for $801,000, you're paying the same as a non-first home buyer type thing.
Yep.
This is a massive incentive for anybody that's trying to take advantage of the first home guarantee scheme. So that's the 5% where if you've got 5% equity available, so deposit, including sort of legal fees and bits and pieces, you can then get into the market with only a 5% deposit.
Because I guess the problem was, for a first homeowner, you couldn't buy land and build with only a $500,000 budget. So now the $700,000 budget enables them to build a first new home.
The big thing was to build, you could buy up to $750,000 through the first home loan deposit scheme. There were some caps at $550,000.
Did you get the stamp duty exemption though, up to
Only on with your land up to 250,000 was the stamp duty exemption on land. For established home, which is where this comes into effect quite well, is because the saving between buying at 500,000 and 700,000 is actually just over 17,500. I think $17,850 is the stamp duty saving that you now see. And a big part of that is with that government scheme is where if you wanted to be part of the first time deposit scheme, to buy for 700,000, you'd need almost about $65,000 deposit just to get into that 5%, because you're paying all that stamp duty as well as the 5% deposit requirements. Now, because there's no stamp duty, you realistically only need about $38,000. So still a lot of money, but to get into that sort of price threshold, you know.
Well, 38's better than 65.
Definitely.
It's a lot better when I went to school anyway.
Definitely.
So at the end of the day, some good news there for first homeowners. What was there? Was there something else? Was there some other incentive?
There's another one that's I guess just recently passed through Parliament, which was passed on the 11th of June. So it's called I can't remember the exact scheme name of it now, but anyway, so it's part of the Labor government incentive for getting people into homes. So what it is for, I guess we're going to say low income earners. So if you earn less than $144,000 household income per annum, your requirement's only a 2% deposit to get into the marketplace. But the biggest thing is the government is going a co-ownership. So where at the moment we're seeing under the first home guarantee scheme is the government is guaranteeing to the banks the 20% equity to make sure that you don't have to pay lenders' mortgage insurance. The new scheme is that the government's going to allow you to buy into those sort of marketplaces, but they're going to contribute 30% deposit, so they'll own 30% of the house. You then only have to fund 70% of the house. So it's going to allow for cheaper repayments and everything along those lines to get into the marketplace, and then you have the potential to buy back that equity off the government over.
But let's say you didn't buy back the equity. The real kicker comes if you try and sell that house. Tell the people at home what happens if you sell that house.
I guess, again, the full details haven't been released. We'll probably get full details by the end of the year. But the biggest kicker is let's say you buy a $500,000 house, you pay for 70% of the property, the government's going to pay for 30% of the property, but in 8 years or 10 years' time, the house is now worth $1 million. Ultimately, they're going to take their 30% of the $1 million. So they'll pocket $300,000 and you're left with your $700,000. So I guess it's going to be interesting to see exactly how they structure the buyback of the equity back off the government. Talk was that it's going to be 5% allowable to be purchased every 2 years. So you can buy back that 30%.
All right. Interesting. We'll see how people feel about that. Like at the time if you get to take advantage of it, you'll think it's a great scheme. But if you get to the point that you have to give the government 30% of the value of the home somewhere 10 years or further down the track, people may not be quite as enthusiastic about that. And they'll think, oh, that's not fair.
Yeah.
But they did get the government's money, 30% of the money for and they borrowed it over an extended period of time. So, okay, a couple of great initiatives there to get people into the market. So first homeowners and non-first homeowners. So probably that's about all we've got time for today, Steve. As always, you're an amazing source of knowledge. So thank you to Steve Beach from Standford Financial as always. Guys, if you've enjoyed what you've heard on today's podcast, feel free to comment, send us questions, subscribe to the link below. We'd love to hear your feedback. If you'd like to see more about what we talk about on The Couch with Steve, please subscribe to our next podcast and we'll see you soon.